What you are about to hear is not a prediction. It is not speculation. It is not a clickbait headline designed to keep you glued to a screen. What you are about to hear is the cold, calculated, mathematical conclusion of 6 consecutive years of supply destruction, institutional repositioning, industrial demand that the world has never seen before, and a monetary system that is quietly, systematically, and deliberately being dismantled in front of your eyes, and most people are still asleep. So if you own gold, if you own silver, if you are considering either one, or if you are someone who simply refuses to be financially blindsided, you need to stay with me right now, because the data I am about to walk you through is not found in a mainstream news segment, and it is not going to be served to you by the people managing the very system that is being destroyed. Let's begin with exactly where we are today, February 27th, 2026. Silver is currently trading at approximately $91 per ounce after an extraordinary run that saw it break its all-time high above $50 per ounce in October 2025, explode to an intraday record of $121.64 in late January of 2026, and now consolidate in the $80 to $92 range. Gold simultaneously crossed $5,000 per ounce for the first time in January 2026, currently sits above $5,000, and major institutional banks, not fringe analysts, not alternative media personalities, but JP Morgan, Goldman Sachs, Deutsche Bank, and Wells Fargo are now projecting gold at $5,400 per ounce by year end. Wells Fargo is telling its clients to buy the dip. Goldman Sachs has a $5,400 target for 2026. Deutsche Bank is calling for $6,000, and JP Morgan, the single largest bank in the United States, is projecting gold at $5,055 by the final quarter of this year and $5,400 by the end of 2027. Now, why does all of this matter for silver? Because this is where the $1,700 number enters the conversation. And I want you to understand where that number comes from, because it does not come from thin air. It comes from one of the most powerful ratios in the history of monetary metals. It comes from historical precedent, and it comes from the structural conditions that are being built right now in the physical silver market, whether the mainstream financial press covers them or not. Let's talk about the gold to silver ratio. Right now, the gold to silver ratio sits at approximately 55 to 1. That means it takes about 55 ounces of silver to buy 1 ounce of gold. Now, if gold reaches $5,000 per ounce, which it has already done, and the gold to silver ratio compresses to 30 to 1, which is not a fantasy number, which is a level this ratio has touched multiple times throughout history, and which is a level it actually breached in 2011 when silver hit $50 per ounce with gold around $1,900, that gives you silver at $166 per ounce. That is just the conservative math. Now take gold to $6,000 and compress the ratio to 30. You get $200 silver. Take gold to $6,000 and compress the ratio to 15. The historical monetary ratio that existed for centuries before the paper system took over, you are looking at $400 silver. But the scenario that produces the $1,700 number is this: gold at $5,000 with a gold to silver ratio of 16 to 1, which is the ratio embedded in the historical monetary system and which was in place for much of American history, gives you $312 silver. Gold at $10,000, a number that JP Morgan's own Jamie Dimon has said is a possibility, at a 16 to 1 ratio, gives you $625. And at a ratio that fully normalizes to reflect the actual geological ratio of gold to silver in the Earth's crust, which is 8 to 1, Gold at $10,000 produces silver at $12,500. Take gold to $12,000 at that same geological ratio, you arrive at $1,500 at that same geological ratio, you arrive at $1,500, $12,500 at that same geological ratio, you arrive at $1,500 at Inzaflubiev. Take game you that dollars piece ability and is no $1,000 any to $1,500. Take game you that daply normalizes piece ability and is no $1,000 piece ability at that Chakaradka team. These are not impossible numbers. These are mathematical outcomes of conditions that are already being constructed in the real economy, the physical market, the monetary system, and the geopolitical order right now in real time. But let me set the theoretical math aside for a moment and take you directly into the physical silver market, because this is where the story becomes not just compelling, it becomes undeniable. The Silver Institute, the most authoritative voice on global silver supply and demand data in the world, released its official findings in February 2026, and the headline number is this: the silver market is heading into its sixth consecutive year of structural supply deficit in 2026. Let me say that again because I need you to really let that sink in. 6 years in a row, total demand exceeding total supply for 6 straight years. In 2021, 2022, 2024, 2025, and now 2026, the world has consumed more silver than it has mined and recycled. The cumulative deficit over the last 5 years alone, from 2021 through 2025, has surpassed 820 million ounces. That is approximately 1 full year of total global mine output vanished, consumed, gone, not sitting in a vault somewhere waiting to be unlocked, gone. In 2025 alone, the deficit was approximately 95 million ounces, according to the Silver Institute. In 2026, despite the massive price rally that you would normally expect to incentivize new supply, the projected deficit is still 67 million ounces. And here is why the supply cannot simply respond to higher prices the way people assume it should. Approximately 70 to 75% of the world's silver is produced as a byproduct of mining lead, zinc, and copper. Silver miners do not simply drill new mines because the silver price went up. They are dependent on the economics of base metals. When lead and zinc prices are suppressed, those mines do not expand. When copper mines scale back, silver output scales back too. The world's largest primary silver mine outputs, Mexico, Peru, Russia, are all facing structural headwinds. Mexico, which produces approximately 186 million ounces per year and is the world's largest silver-producing nation, faced regulatory changes in 2024 and 2025 that cut output in affected regions. Russia's silver sector continues to face capital constraints due to sanctions. Multiple major primary silver mines globally are approaching end of life with no significant replacement projects ready to come online. The World Silver Survey published in 2025 stated explicitly, and I want to quote this for you directly, mine production is expected to peak in 2026 and then fall as several mines reach end of life. The report concluded that this deficit situation is clearly unsustainable. Meanwhile, on the demand side of the equation, something revolutionary is happening, and revolutionary is not an overstatement. Industrial demand for silver in 2025 was 665 million ounces, down slightly due to price-related thrifting, but still the dominant demand category, and the drivers of that industrial demand are not cyclical. They are not going away. They are expanding. Solar photovoltaic manufacturing consumed over 25% of the entire global annual silver supply in 2024, and that number is growing. The Silver Institute projects solar demand to nearly double between 2020 and 2030. By 2050, cumulative solar demand for silver could consume the equivalent of 85 to 98% of all known silver reserves on the planet. Electric vehicle production consumed an estimated 20% more silver in 2025 than the year prior, driven by the growing use of silver in sensors, high-voltage wiring, and battery management systems. And now we have the emergence of AI data centers, a demand category that did not even exist as a meaningful silver consumer 3 years ago. Silver's superior thermal and electrical conductivity makes it essential for the high-performance computing hardware that powers artificial intelligence infrastructure. As of late February 2026, market analysts covering the semiconductor and data center space have begun explicitly flagging silver as a critical supply constraint for AI expansion. The LBMA and COMEX vaults, which serve as the physical delivery points for the world's paper-silver contracts, have seen inventories drawn down to levels not seen in over 2 decades. This is not speculation. This is documented. This is in the reports. Available good delivery bars tightened significantly through 2025 and into 2026, contributing to what the Silver Institute itself has described as tight physical supply in London that may remain relatively tight going forward. In October 2025, when silver hit its all-time high of 54.48, there was a physical liquidity squeeze in the London silver market. Roughly half of all silver-backed ETPs globally are held in London, and when prices moved rapidly, the scramble for deliverable metal created extraordinary price pressure. That squeeze happened with silver at 54 point. Imagine what happens when institutional allocators, central banks, sovereign wealth funds, and millions of retail investors in the West, who have been largely absent from this rally, finally rotate in. The Silver Institute itself flagged that Western physical investment demand is expected to rise 20% in 2026 to a 3-year high of 227 million ounces. As investors who sat on the sidelines during 2023, 24, and early 2025 finally recognize what is happening. Now let's talk about the monetary story, because this is the layer that ties everything together, and it is the layer that connects gold's move above $5,000 directly to silver's ultimate potential. Gold crossed $3,000 per ounce in February 2025, immediately following Moody's credit rating downgrade of the United States to AA1. This was not a coincidence. This was the market telling you something. The U.S. national debt surpassed $37.8 trillion in late 2025. Interest payments on that debt have grown by more than 3 times over the last 5 years and have become the second largest expenditure in the entire federal budget, surpassing defense, surpassing Medicaid, second only to Social Security. The M2 money supply in the United States expanded by approximately 40% during the COVID period, from roughly 15 trillion to 21 trillion, and has continued growing. As that money supply expands and as debt compounds, the purchasing power of every dollar you hold is being quietly, legally, systematically extracted. Gold has been keeping score. The M2 to gold ratio currently stands at 4.5, and analysts who track this metric closely note that during the early 1980s, that ratio reached as low as 2.5, which implies that even now, with gold above $5,000, it remains historically undervalued relative to the money supply. The debasement trade is now the dominant narrative in global institutional finance. This is no longer an alternative media talking point. Deutsche Bank issued a research note calling for $6,000 gold in 2026, driven by persistent investment demand and de-dollarization. Societe Generale's analysts described the $6,000 target as potentially conservative, depending on geopolitical escalation. UBS published an upside scenario of $7,200 gold. Wells Fargo raised its year-end target to $6,300 and told clients to buy the dip. State Street Global Advisors assigned a 30% probability to gold reaching $5,000, which it has already done, and sees $5,000 plus gold as viable given the structural themes around the alternative fiat and debasement trade. Central banks purchased more than 1,000 tons of gold per year for 3 consecutive years from 2022 through 2024 and are expected to purchase approximately 755 tons in 2026, still nearly double the pre-2022 average rate. Countries across the BRICS alliance and beyond are reducing U.S. dollar reserves and replacing them with gold, not with other currencies, not with Bitcoin, not with euros, with gold. The precedent set by the freezing of $300 billion in Russian sovereign reserves in 2022 sent a shockwave through every central bank on the planet. The message received was unambiguous: dollar-denominated reserves can be confiscated at will. Gold in a domestic vault cannot. Now, here's what I need you to understand about the relationship between gold's rise and silver's potential, because this is critical and it is consistently underappreciated. Silver has historically lagged gold in the early stages of a precious metals bull market and then outperformed gold dramatically in the later stages. This pattern has repeated itself in every major precious metals cycle. Gold moves first. Institutions, sovereigns, and central banks accumulate gold first because it is the larger, more liquid, more historically established monetary metal. Then, when gold's rally becomes undeniable and investor psychology shifts from skepticism to participation, capital rotates into silver, and because the silver market is approximately 1/10 the size of the gold market in dollar terms, that capital rotation produces proportionally much larger price moves. Silver rose 147% in 2025 alone. Silver hit $121 per ounce in January 2026, a level that would have seemed absurd 12 months earlier, and we are still in the early innings of the institutional participation phase. Global silver ETF holdings rose approximately 18% through November of 2025. That is a meaningful number. But compare it to what happened to gold ETF inflows in the same period, and you will see that the silver ETF market remains far less saturated by institutional capital than gold, which means the runway ahead for silver is arguably longer and steeper. The gold to silver ratio, which breached 100-to-1 in early 2020, meaning it took 100 ounces of silver to buy 1 ounce of gold, compressed dramatically through 2025 as silver's price surge outpaced gold's. By early 2026, the ratio fell below 50-to-1 for the first time since 2012. That compression is the mechanism by which silver closes the gap with gold, and every time in history that this ratio has compressed from elevated levels, silver has produced generational wealth for those who held it patiently. In 1980, when this bull cycle last reached its crescendo, the gold to silver ratio compressed to approximately 17-to-1 point. Silver hit $50 per ounce at a time when gold was approximately $850. If that same ratio compression plays out in this cycle with gold at $5,000, silver at 17-to-1 gives you $294 per ounce. With gold at $6,000 and a 17-to-1 ratio, you are at $352 per ounce. These are not extreme scenarios. These are historical precedents applied to the current gold price. So where does $1,700 come from? The $1,900 scenario requires two things to be true simultaneously. Gold continues its bull cycle to levels that multiple major institutions are already forecasting, specifically in the $10,000 to $14,000 range that has been discussed by Mike Maloney and others. When the full cycle plays out and the gold to silver ratio reverts to the geological and historical monetary norm of 8-to-1, gold at $10,000 at an 8-to-1 ratio is $1,000. Gold at $14,000 at an 8-to-1 ratio produces $1,750 silver. The midpoint of that scenario cluster produces approximately $1,400 to $1,700 per ounce. Is this a near-term forecast? No. Is it mathematically coherent given the structural conditions in the physical market, the monetary debasement underway, and the historical precedent for precious metals cycle behavior? Absolutely yes. And what makes this cycle potentially more powerful than every previous one is the combination of the monetary collapse story and the industrial demand story occurring simultaneously for the first time in history. Silver has never before been simultaneously the most critical monetary hedge in a debt crisis and one of the most essential industrial commodities in a global energy and technology transition. Both of those things are true right now at this moment in the year 2026. Let me bring this home with the data points that matter most for you as a physical owner of gold and silver. First, your silver already crossed $50 per ounce for the first time in its history in October 2025. That psychological barrier is now behind us. That it is not a ceiling anymore. It is a floor that was tested and held. Second, the physical market deficit is not a temporary anomaly. It has persisted for 6 years. It will likely persist for years more given the supply constraints, the end-of-life profile of major mines, and the accelerating industrial demand from solar, EVs, and AI. Third, Western retail investors, the people watching videos like this one, have only recently begun to participate in this market. The Silver Institute confirms that Western physical investment demand is expected to rise 20% in 2026 after 3 consecutive years of decline. You are not late. You are in the early majority of what is likely to be a multi-year acceleration. Fourth, the monetary destruction story is not over. U.S. debt is still growing. The Federal Reserve is still navigating between inflation and recession. Global central banks are still accumulating gold. De-dollarization is still progressing. None of these dynamics reverse in a quarter or a year. Fifth, the gold to silver ratio at 55-1 is still historically elevated, which means silver is still historically undervalued relative to gold. Every point of compression in that ratio from here represents disproportionate gains for silver versus gold. What do you do with this information? You do not panic. You do not speculate with money. You cannot afford to lose. You do not leverage yourself into paper silver contracts that can be subjected to margin calls in a volatile market. What you do is make a calm, informed, deliberate decision about whether physical metal belongs in your financial strategy, given everything you now understand about the money supply, the debt structure, the supply deficit, the industrial demand, and the historical behavior of these assets in cycles like this one. Physical silver that you hold in your possession cannot be frozen. It cannot be confiscated by an algorithm. It cannot fail a counterparty risk test. It does not require a bail-in. It does not go to zero. It is not a promise. It is not a liability. It is not a currency that can be printed. It is a physical element, number 47 on the periodic table, that took millions of years to form in the Earth's crust, that human beings have used as money for over 5,000 years, that the entire modern industrial economy now depends upon for its solar panels, its electric vehicles, its semiconductors, and its artificial intelligence infrastructure, and there is simply not enough of it. The supply math does not add up. The demand math does not lie. The monetary math is staring every honest economist in the face. And the institutional money that has already moved into gold above $5,000 per ounce is the early tremor before the larger wave that moves into silver. The $1,700 silver story is not science fiction. It is the logical endpoint of a process that started in 2021, accelerated through 2025, and is now reaching the phase where the data is so clear, so well documented, and so confirmed by the most respected institutions in the global financial system that the only remaining question is not whether it is when and whether you are positioned to benefit from it or forced to watch it from the outside. You have been paying attention to the right thing. Now make sure the people you care about are doing the same. because this window, this moment when physical silver is still accessible to the average person, when it can still be purchased at prices that will look historically cheap, does not stay open forever. Nothing in this conversation is financial advice. It is data, it is history, it is pattern recognition, and now it belongs to you